2007 is when you started Pi Funds, correct?
Yep. Yep.
And you started that. Tell me the whole thinking around why you wanted to do that. What was the genesis of that idea?
Of my baptism by fire.
Yeah.
So I go back to Massey, when we were both there at a similar time, 98, and I was the guy ducking out of lectures to put trades on in the kind of the dot-com era,
Yeah.
and buying technology businesses then.
Yeah.
And I got a $3,000 student overdraft, which you could take at the National Bank.
That's right.
During
I
that
remember
period.
that. I think I had one as well.
Yep.
Yeah.
And then I realized that wasn't enough capital. I needed to borrow $10,000 from my parents, which gave me strict payments to pay back $1,000 a month with 10% interest.
Wow. Good parents.
Yeah, good financial discipline.
Yeah, that's good. Okay.
So yeah, I had 13 grand of capital, and that's what really got me started. And then I just really loved it. But I, unfortunately, even though I wanted to, straight out of university, just go like a full-time day trader, that was my dream, I realized that I still didn't have enough capital and that I probably had to get a job. And so I got, jobs, various different jobs. First graduate job was in banking. And then that wasn't right because I was in credit and I wanted to be in trading.
Right.
So I moved to equities and foreign exchange trading for a period of time, and then kind of that fast forward to 2006. And sort of actually over the in between years, so from 2000 to 2007, friends and family noticed that I was quite good at what I did.
So that 13,000 that you had way back when?
Yeah,
Still,
I did
still
grow
there, or did you?
No, so by the time I'd started Pi, I'd grown that to about 250,000 in capital.
Awesome. Yeah.
Yeah. So friends and family were like, this is going pretty good. Mike's good at what he does. So first my parents gave me a little bit of money, then my sister gave me some, and then Dad's friend, someone else, and then one of my friends' parents, and so on and so forth, until I had about 10 people and about $3 million.
Right. Was that right? And that
capital
was
by 2007. Some of that was gains, and some of that was just the capital.
Yeah.
I compounded my money at about 45% per annum from when I started until 2007. And everyone was like, this is awesome. If you start a funds management business, we'll roll our $3 million in, and we'll tell all our friends, and we'll get you some new clients, and you can turn it into a legitimate business. And I thought, yep, this is good. What do I need to make this work? Probably 20 million. I'll just be the only employee. It'll just be me in a room like this.
in a padded cell somewhere.
In a padded cell. Yeah, I actually had this windowless office.
Right.
There was a tiny little strip at the top, and it had bars on it.
Yeah.
It was like an old IRD building or something where they used to put people who didn't pay
Didn't
their
pay the
returns.
taxes.
Yeah. And that was my padded room.
Yeah.
So I went in there, but what happened was, because I left my job and started 2007 to get this set up. I was ready to go by December. It took some time to get regulated,
Yeah.
etc.
Yeah.
And then the first month
Yeah.
of operation, I lost 10%.
Right.
And that was difficult to take,
Right.
as you can imagine.
Well, but you could point to the environmental considerations at the time, right? To a
Yeah,
certain
you
extent.
lose people money, you can't point to the environment.
True. Yeah.
They
They're
don't
not going
care
to buy
about-
that story, are they?
They're not going to buy that story. And so I couldn't get any new clients. As 2008 rolled on, it became, there's a few people who might have joined through that year, but it got harder and harder. And I kept losing money. And so I didn't have much to do during the day other than sort of just study and analyze. And so I spent a lot of time analyzing bear markets because I knew we were in one. And I bought this book called The Anatomy of the Bear,
Okay.
which is a very good read,
Okay.
published in 2007, I think.
Okay. The Anatomy of the Bear.
Anatomy of the Bear.
Cool.
And I started cashing up the fund and recognizing that cash was a really good way to protect your money rather than trying to use complex derivatives or buying defensive stocks or anything like that. It's
So
just,
rather than short selling stuff or
just forget
put
it. They
options, just-
banned short selling was banned.
So your only option to hedge was just to hold cash reserves, really.
Yeah, you could have used derivatives,
Yeah.
futures and options and things, but I thought let's just use cash.
Yeah.
And then I can say to investors, look, the maybe dozen or 15 who were there, the funds in cash. Even in saying that, after Lehman's went, and so equities were probably down 60%. I was still down 30.
Okay.
So
Okay.
yeah, I was half the fall,
Yeah, it's
but
good.
still lost people a lot of money,
Yeah.
and they weren't happy.
No. Okay.
It was pretty hard
So
to go
those
to the
those bars in the window came in pretty handy then. At that
yeah.
stage.
So my son was born in February '08, and I remember some of those kind of early catch-ups with family and the barbecues and things, and
Awkward.
yeah, people were like, "Well, how much money have you lost me?" And
Yeah.
there were a lot of difficult moments and navel gazing and thinking, why have I done this? My parents said, "Oh, you should never have left the bank." I later told them that the bank I was at went bust. I was at Merrill Lynch and they got bailed out. So I probably
That's
would have
why.
lost my job there anyway.
Yeah.
So
Man.
yeah, I mean-
because everybody kind of when they tell the story, I've never had anyone tell their story of how they started with such honesty. Like normally you skip out those horror stories and you
Yeah.
just say, I was a freaking genius and
no,
Yeah,
it was brutal.
It was hard, was it?
It was so I put of the 200 something grand, I put in half of that into capital into the business to fund things, which then kind of subsequently took out for wages for myself and a few other things. But probably by June, I talked to the other directors and said, look, I just can't. There's no money left. I can't pay myself. So we had 2 cars. We sold a car, and then we just cut expenses. We went into austerity mode.
Yep.
Cut expenses right back. We sold a stereo. We sold some other furniture on Trade Me, and kind of raised, I guess, I don't know, 35,000 to just see us through.
Yeah.
For a period.
Yeah.
And that was very challenging.
To say the least. I'm picking up that it was
Yeah.
even worse. It was tough time, was it?
Yeah. And so fast forwarded to kind of March '09 actually, and in a pretty dark place. And then there was a change in sentiment in the market. It was pretty hard to pick up if you weren't right finger on the pulse, because believe me, people remained bearish for a long time after '09. I think it would have been 5 years. I still approached clients that were still negative. But in that period, so the fund was 80% cash, and I basically stabilized everything by Lehman. So from October to March, even though the market kept falling, we didn't fall.
Right.
And this client called. He's now a director, actually. Literally like the day of the bottom, and he goes, "Oh, are you putting any money in the market?" And I said, "Oh, don't be ridiculous.
Yeah.
It's only one day." And he goes, "Yeah, but maybe it's changed." And so I thought, well, maybe it has changed. So I went back to my anatomy of the bear, and I developed these indicators to say, because there's about 10 I came up with, and I called them traffic lights, and I put them in my newsletter and everything. And I said, actually, things are changing. Maybe we're at a bottom. So by April or May, I can't remember the exact date, I was fully invested.
Wow, you redeployed all that cash.
I redeployed all the cash.
Yeah.
And by June, I had all these indicators telling me everything was green. I was correct, should be fully in the market. And there was still so much pessimism around.
Interesting.
And of course, that's what, bear markets are born on, pessimism, right? So that year I made 105%.
Wow.
In equities.
And that was 09.
09.
Yeah.
So made up the 30 that I'd lost from the year before and put on some gains as well.
And you were away again.
And I was away again.
The wind picked up.
The wind picked up.
Yeah.
I could pay myself again.
Yeah.
3 million became 7 million under management.
Yeah.
New clients came. People were like, "Oh, look at this guy, Mike. He's made money when everyone else is." Because people by the end of '09, they were still down.
That's
I
right.
mean,
Yeah.
I remember a lot of managers, if you're in a passive fund,
Just putting it out there.
it might have been 6 years until you got back to break even.
Yeah.
From the peak.
That's right.
Or more. People who are in passive funds in the .com, they went all the way down. They got back to where they were by 2007, and they'd start again.
Yeah.
So,
And that's why I guess it's easy, especially going back to this whole active versus passive thing. It's really easy to say that paying extra fees to be inactive is a waste of money when the market's really exuberant and there's been quite a few years of those gains, because you can just say, well, why bother when everything rises on a rising tide? Don't worry about it.
Yeah.
But your whole business went through this period where you were challenging the platform, going through some really tough times, but it was the analysis, the research, the hard work that you put yourself through that set you up for massive success later on when it happened. And if you didn't go through that, you could say that none of that success would have happened to a certain extent, right?
Agreed. Yeah. And, part of the reason why, fast forwarding to today, is I'm so quick to be in cash is because of the experiences I had in 2008. And sure, maybe we've given up some upside over the years because we have carried more cash than we probably needed to. But if you look at our long-term results, we're still ahead of benchmarks and everything. So I say, well, not really, So if we can outperform in up years and massively outperform in down years, then we're doing what we're paid to do.
Okay, good. Now, so I don't even know how we got onto that. I think we were just talking about other parts of the business, right?
Yeah.
So if we were,
you wanted the start, how we started.
Oh, that's right. Yeah, the start.
Yeah.
Okay. But in terms of the other parts of the business that happen right now, we've got a wealth advisory business.
Yep.
And then just pure funds management, right?
Pure funds management. We do have direct retail clients.
Yes.
We started the wealth side because lots of clients need advice.
Okay.
So we're kind of migrating some of our existing client book over to getting financial advice.
Gotcha. Yeah.
As well as bringing in new clients.
And the team is growing in terms of the advisory business. Is that something that you see growing in coming years? More of a need for advice for people, say $500,000 plus that want to invest. Is that a growing space? Yeah,
it's our fastest. Other than Kiwisaver, it's the fastest growing part of the business at the moment. So we have 2 financial advisors now, and we'll expand that. Yeah.
As you go. Cool. And so the other part of the business is effectively just what you just create funds. Is that how?
So we have 10 products in Pi. Yeah. And they do different things. So there might be a global equity fund. We've got a UK fund. We've got 4 that do Australasia. One hedge fund. We have an ethical climate fund. So different products for different people.
And with JUNO Kiwisaver, would some of the funds be going into those funds?
No. So the Kiwisaver's 3 separate products: growth, balance, conservative.
Yeah.
The same investment team, but they have a different focus.
Gotcha.
Yeah.
And on the private wealth part of the business, they're more open to the market, right? So they can work across, not just.
Correct. So they may allocate to non-Pi funds products.
Yeah.
Unlike the banks, who will only allocate to their own products, if we see products out there that we don't cover, then we might buy a bond or whatever that covers that aspect. Okay. Yeah.
Now, you referred to software as a service business, and that's what you see the JUNO Kiwisaver as a software as a service business.
Yeah.
What do you see in the next, say, 5 to 10 years in terms of innovation? Do you see that the model that you're currently working with, do you see that evolving much?
So that could come into the general funds management business as well. Okay. So it started a little bit overseas, and kind of a watch this space in terms of us as to whether we do that. But the logical move and why we're doing it in Kiwisaver is that's what we believe suits the Kiwisaver market is a software as a service, a subscription fixed fee amount for what you pay for your Kiwisaver.
Yeah. Okay.
So
and
it will be very hard for the incumbents to change their model. It's kind of like Airbnb comes in, and how does Sheraton react? They can't just change their model, right?
That's right.
So what happens is that the market expands a bit. So that means maybe more people join Kiwisaver, so the market will expand, and the traditional players lose market share.
Gotcha. So things get bigger, more players in there, and that effectively displaces the competitors out there that are offering a percentage fee model versus.
So at the moment there's 2.8 million in Kiwisaver. Look out 5 years, maybe the market's expanded to 3.5 million.
Yeah.
And the market share that the banks will have dropped
Yeah.
from where it is today.
Yeah. Okay. Approaching the end of our time together, Mike. So I just wanted to thank you again for joining us today. Really appreciate your time. Is there anything that you wanted to impart or share? Anything else that you want to cover?
Just to talk about, investing in general, I think would be a good thing to spend maybe 5 minutes on.
Let's talk about that.
Is that, investing is not easy, but it doesn't need to be hard. And I realize that's a bit of an oxymoron, but a lot of people think making money is easy because they've been in the market's gone up, their property's gone up. They say, well, this is easy, anyone can do it, right? But they don't realize, as we said earlier, that markets are cyclical and things can go down.
Yeah.
But when I say that it doesn't need to be hard is because a lot of people, even investment professionals, overcomplicate things. Is what is a relatively simple thing that you need to do is that you are trying to buy an asset that you think will go up in value.
Right.
That's what you're trying to do.
Simple.
Pretty simple. So you need to make a common sense assessment. Is this asset expensive or is it not? When I'm, is it a fair price when I'm buying it? And over the years, I've found that, which is why I like the book One Up on Wall Street. Another one I recommend reading by
One Up on Wall Street
by Peter Lynch.
Okay.
He was one of the best ever fund managers, and his style basically was that he'd buy businesses in the States that, he'd say, buy a business that any idiot can run because sooner or later any idiot will run it. And
good.
it was just like so easy, when Walmart first started, how could this not work? How could this business not grow? I can think of examples in New Zealand we've had is that, you look at, say, the warehouse when that first started and what they was doing. It was just, they're rolling out stores. This is working. It's full. It's obvious. This is going to go well. And anyone can do that by just walking into a warehouse.
And see it.
Yeah. Or, zero accounting software, as you can see that, and I know at some point it had a very egregious price, but in the beginning you can say, well, look, everyone's moving to this online accounting software, so it's got good odds it's going to work, and so that's why I went from $1 to $45.
Because people often will kind of almost attribute a certain sort of mysticism around choosing, but it's really simple, isn't it?
And other things, it's like, I wouldn't suggest, this is a little bit different now because Apple has saturation, but go back to when the iPhone was first invented, right? So I got my first in 08 or 09, somewhere around there. Now, this is revolutionary. And everyone was saying, who was it? I think it was maybe one of the Nokia or someone else.
BlackBerry or...
Yeah, BlackBerry. It's like, oh, no one's going to buy these, right?
Yeah.
But when you use your first iPhone, you're like, this is going to revolutionize the world. And so you just make an investment decision based on common sense.
It's really not that complicated,
It's
like
not.
you say. It doesn't. It's not easy, but it's also not hard. I get what you're saying.
So, that's why I say anyone can be an investor. But when you start to complicate things and say, what do I think, the growth rate of this company is going to be? Is it going to be 5% or is it going to be 7%? And what are the interest rates in the US going to do? And start adding all these other complications in there. That's when it becomes too hard.
Gotcha.
And
because you focus too much on the macro and not enough on the micro.
Yeah.
Right.
And I'm sure it's the same because I'm not a property investor, but I'm sure it's the same with property. Is that let's say buy the worst house in the best street, and all those kind of things. It's just, I guess my point is that it's not easy because there's lots of pitfalls. You can succumb to emotions, all that kind of thing. But don't make it hard for yourself.
Yeah. Well, it was one thing that really we had Lance Wiggs from Punakaiki Fund on the show maybe a couple of weeks ago, 2 or 3 weeks ago. And that was what came out there is that, even as an angel investor, investing is work. It's not just throw money at something and the money does the work. Get your money working for you. That's kind of to a certain degree, that's a bit of a myth.
Yeah.
But I guess there's a balance somewhere in between those two bookends. There's a balance. You don't want to get paralyzed by overanalyzing and overcomplicating and looking to the external and all the environmental considerations. Just distill it back down to the real simple thing. What's selling right now? Where are the people going?
And the last point to make is that it's never too small to start. So I started with that $3,000 exactly 20 years ago. And, I look at what I've achieved in 20 years. And sure, maybe people won't go down my career path to get there, but it means that they can turn their $3,000 into a significant sum if they've got a long enough time period.
Yeah.
Don't try and do it in 6 months.
Yeah.
But if you've got a long time horizon, you can start with $3,000 and you can add to that every month. And
dollar cost average in, whatever it is.
whatever you need to do, but
Yeah.
you can start with a tiny amount of money.
Yeah.
Don't think, I haven't got $100,000, so I can't start.
Gotcha. Everybody, to a certain degree.
Everybody can be an investor.
Yeah. That's good. All right. Anything else, Mike? I've written all this down. That's good.
That's good. I'm done. Yep.
You're spent. That's it. All right. No, I really appreciate it again. Thanks, Mike, for coming in. Now, if people want to find out a little bit more about what Pi Funds does, or Kiwisaver in particular, where can they go?
So if you want to find out about our great KiwiSaver offering,
Yep.
you can go to junokiwisaver.co.nz. That's JUNO.
Yep.
And if you want to find about Pi Funds and our financial advice and wealth offering, it's pifunds.co.nz.
Sweet. Awesome. Thanks again, Mike. Really
Thank you.
appreciate your time.